Yes, that's one. Okay, so I want to just real quickly sort of review the bailout, because what you've seen is this, what you perceive is this continual flow of dollars from our pockets into somebody else's pockets. But I would suggest to you that what's really happening is a move not to reimburse people, or really not even to bail out people, but a move, as Dr. Davis suggested, to instill confidence in the system. So what's happened with the bailouts is that the first sort of area where the bailouts take place is in this realm of investment banking. And I don't really want to rediscuss the Great Depression, but one of the reasons that we have investment banks is because of the Great Depression. So in 1933, some of the banking reforms from 1933 to 1936 significantly restricted what you and I know as banks could do. And so the investment banking function was moved outside of the regulatory environment. So the institutions that she had on a slide that you look up there and no longer exist were institutions that were essentially less regulated than commercial banks. They may be subject, they are subject to significant regulation from the SEC, but not from the Federal Reserve, and certainly not insured deposits and those kinds of things. So the name bank may mislead you and I because it's a broad term that's used a little bit differently. But the important thing here is that they're not regulated. So the bailout, what the bailout does, as you go through that list that she presented, and those investment banks became converted to commercial banks, one of the things that does in the long run is that it makes those regulated institutions. But what it also does, it's going to change significantly the function of investment banking and how we do that. And that's, like so many things in this process, that's something that's really very unclear. The second area of bailouts would be with commercial banks, and commercial banks would be what you and I would call banks. So you and I, as we talk, we wouldn't say commercial banks, we would just say bank. And that may apply to all sorts of different things, but a place that accepts your deposits and takes your checks and makes your loans and does all of those things. That's a commercial bank. So one of the things that's happened in the commercial banking industry is that some of those banks, as Dr. Davis suggested, some of those banks are holding Freddie and Fannie, and they have problems because their capital adequacy is reduced significantly, and that impacts their ability to make loans. Then we encounter this liquidity crisis. And so the response is, the bailout response has been to inject capital in the form of new ownership, but then also to inject liquidity. And I'll talk a little bit about liquidity in a couple of minutes, but to inject liquidity so that banks would again feel comfortable making loans. As of this morning, there's still no evidence that larger banks are particularly yet comfortable doing that. Some of the bailout functions really aren't. So many of the institutions that went under, or that have been closed over the past 6 months or so, are institutions that were actually closed by the FDIC for illiquidity and for not meeting different regulatory rules, usually capital adequacy. Some of those large and some of those very small. But some of that wouldn't be really classified as the bailout. It just gets all lumped in here because all this stuff is happening at the same time. And then we have this set of things that I'm going to call non-banks, which are sort of the rest of the financial institutions. And so what we see here in the bailout is one of those times in our history when we actually move out of the traditional way that we would regulate financial institutions and even how we would deal with financial institutions as a people and look at them very differently. And the other times that we've done this have been in those times of crisis, like the Great Depression. We did it, unfortunately, the Great Depression, we did it 100% wrong, but we did it. And also, as a function of the crash of '87, we did that. And then some other things you may have heard about us loaning money to Chrysler Corporation back in the 70s and 80s and things like that. So we have done this other times where we've gotten involved with the private sector. So the bailout really sort of ends up being these three things. Now I want to think about the sort of the problems. And liquidity is the term that gets thrown around a lot. And economists have a thing, comes from Lord Keynes, who developed the work on this. And he developed an idea that he thought he observed every once in a while called a liquidity trap. And what happens in a liquidity trap is that the economy basically turns to cash. So You've heard of a run on a bank. We've seen just in the last couple of months, we've seen a couple of runs on banks. They're fascinating things. I got to watch one back in the 1960s, and literally people line up to get their money out, and so they turn it to cash. Now, what happens there is that if banks don't have money, they can't loan it out, and if they can't loan it out, then businesses can't borrow it. And if businesses can't borrow it, one of the things that happens, there's a lot of short-term lending in our economy for things like payroll. So if you're trying to make payroll on Friday and you're trying to smooth out your cash holdings, you may in fact have a small line of credit where you're going to borrow a couple $1 million every week. You're going to pay it back on Tuesday, you're going to borrow it on Thursday, all your checks are going to be good, everything works. Well, all of a sudden, you go to your banker and your banker doesn't have any money because you and all of your employees have drawn the money out. So we have this liquidity problem. Liquidity trap means that simply the financial sector, banks, don't have any money to loan. Now that's different than a credit crunch, because a credit crunch would be if they're unwilling to loan. And we're seeing some evidence of both of those happening in our current environment right now. The second sort of interesting theoretical aspect that we have here, again, that we don't see very often in our economy, is something called the paradox of thrift. And the paradox of thrift occurs when individuals have income and choose not to spend it. Now, you and I live in a consuming society, so that's really not too much of a problem. But it potentially really could be. So it's sort of, and that's why it's a paradox, because if everybody increases their saving and we reduce our consumption expenditures, then it takes that much longer for the economy to recover. I'm not suggesting to you that you immediately call your folks and say, look, the guy said, I went to this meeting, the guy said we had to spend an extra $1,000 or something. Don't do that, okay? Because, this is one of those really weird things where what's good for the individual, increasing saving, paying down your debt, those kinds of things, may not actually be good for the economy. And so we really need some level of spending. There have been several articles in the Wall Street Journal over the last couple of days about the need for consumer spending. And one of the things that's happening with liquidity is that as we withdraw it from banks and banks can't lend it out, then we panic and we hide it in a mattress or something like that. I noticed a statistic a couple of weeks ago, a weird statistic, that the sale of home safes has almost doubled in the last month. So I assume that home safes are replacing mattresses for us to store our money. That does the economy absolutely no good. So we have to sort of think about how these things are going to play out.